Good morning. These are the things that matter most in Europe's market today. Oil has forced a new inflation test. Tariffs are hitting export confidence. AI spending is being repriced, and Europe's credit channel has to prove it can absorb the shock. The central question is simple. Can Europe stay selective and resilient when energy, tariffs, and rates all tighten the filter at the same time? Start with oil. Brent has moved through the $100 area after fresh Middle East escalation, and that matters for Europe because the region is a large energy importer with very different sector exposures. The headline is not just higher crude. It is a margin test. The cleaner side is energy producers and energy security exposure. Shell, TotalEnergies, and BP should be watched for confirmed crude sensitivity. Pressure sits with airlines, transport, chemicals, and consumer companies where fuel or input costs are harder to pass through. For private investors, the takeaway is to split the basket. Oil can lift one part of Europe and hurt another. The useful question is not whether oil is important, but which listed groups actually confirm the move today. Second, tariffs have become a Europe open issue. The overnight feed points to new U.S. tariff pressure across a broad group of countries, and Asian exporters traded lower. For Europe, the read-through is export margins, supply chains, and companies with U.S. or China demand sensitivity. Potential beneficiaries are firms with local production, pricing power, and less exposed supply chains. Pressure sits with car makers, industrial exporters, luxury demand sensitivity, and companies where tariffs arrive before pricing power can respond. For private investors, this is not a trade signal. It is a stress test for Volkswagen, Stellantis, BMW, LVMH, and industrial suppliers. Do they behave like global demand winners or like margin risk names? Third, AI is still a market driver, but the mood has shifted from label to funding proof. The overnight market was hit by technology weakness, and the FT reported higher borrowing costs around Meta's large data center financing. Europe does not own the U.S. platform story, but it does own important pieces of the supply chain. The stronger side is chip equipment, power infrastructure, data center capacity, and enterprise software with visible orders. Pressure sits with AI-labeled stories where the revenue bridge is vague, or where higher financing costs make the theme less forgiving. For private investors, the takeaway is plain English. AI can be strategically huge and still be a bad market filter if public companies cannot show orders, margins, and cash flow discipline. Watch ASML, Infineon, and Schneider Electric as confirmation names, not as automatic winners. Fourth, rates are back in the story because energy inflation changes central bank comfort. CNBC reported that traders were looking at a possible September European Central Bank rate hike as policymakers weighed the energy spike. At the same time, the dollar and yields were firm, which tightens the global financial backdrop. The cleaner side is banks with quality credit books and companies that can defend margins. Pressure sits with real estate, leveraged small caps, long-duration growth, and domestic cyclicals that need easier financing conditions. For private investors, the useful filter is credit quality. If higher oil pushes rate expectations up, a rising index can still hide stress underneath. Banks, real estate, and small caps should confirm whether Europe's real economy is absorbing the move. The underappreciated story is the ETF product flood. The FT reported that fund firms are launching more than 1,000 ETFs this year as providers search for the next hot trade. That sounds like industry plumbing, but it matters for private investors because every market narrative now arrives packaged as an easy theme. Potential winners are scaled asset managers, exchanges, and platforms that benefit from flows and product breadth. Pressure sits with crowded thematic funds, fee competition, and investors who confuse a good story with a useful confirmation signal. For private investors, the takeaway is discipline. A theme can be convenient, popular, and still not be the right confirmation tool today. The product label is not the investment thesis. Here is the stock-led watch list. Shell, TotalEnergies, and BP. Does crude strength show up in European energy shares, or does the broader market treat oil as an inflation shock? Ryanair, IAG, and BASF. Do fuel and input costs create visible pressure in airlines and chemicals? Volkswagen, Stellantis, and BMW. Do tariffs and Asian exporter weakness hit the European carmakers, or does pricing power cushion the move? ASML, Infineon, and Schneider Electric. Does AI infrastructure stay investable after the financing cost warning, or does the market demand harder proof? BNP Paribas, Deutsche Bank, and Vonovia. Do banks absorb the rate story while real estate shows pressure, or does credit stress broaden? Amundi, DWS, and Euronext. Does ETF product growth look like healthy market access, or like late-cycle theme chasing? Market bias, selective, inflation-sensitive, and proof-driven. Europe can still find winners, but the market is no longer rewarding every big theme equally. The mistake to avoid is forcing one macro story onto every stock. Oil, tariffs, AI, and rates can point in different directions at the same time. For private investors, confirmation matters more than the headline. That is the Europe Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.